A document was released, quietly. No headlines, no press conference. Just a policy change that cuts off 70% of the world's refined silver supply. And it went into effect while you were sleeping. This is not about trade wars. This is not about tariffs. This is about a country that refines more silver than the rest of the planet combined, deciding that from now on, that silver stays inside their borders. And the industrial supply chain that powers solar panels, electric vehicles, semiconductors, and military technology just got severed at the source. Most people have no idea this happened. The headlines did not cover it. The financial networks did not discuss it. But the people who understand commodity flows, the people who run factories, the people who source materials for global production, they saw it immediately. And they are moving fast. Let me show you what just changed. On the first day of this year, China implemented a new export control policy. Silver is now classified as a strategic material, same category as rare earth elements, same restrictions, same government oversight. Only 44 companies in all of China are authorized to export silver. 44. And every single export requires explicit government approval. It used to be thousands of companies. It used to be a free market. Now it is a controlled gate. And that gate just closed. Here's what that means in practical terms. China refines between 65 and 70% of all silver produced globally. Most of that refining happens as a byproduct of other mining operations. Copper, zinc, lead. The silver gets separated, refined, and then exported to manufacturers around the world. But now that flow has been restricted, not reduced, restricted. The silver that used to move freely from Chinese refineries to Japanese electronics manufacturers, to European solar companies, to American military contractors, that flow now requires permission. And permission is not being granted at the same rate it used to be. This is where things stop making sense. If you're running a solar panel factory in Germany, you need refined silver to produce conductive paste. You used to order it from China, reliable, consistent, affordable. Now your supplier tells you there is a delay. Government approval is taking longer. Quantities are being reduced. Prices are going up. You call another supplier. Same story. You call a third. Same problem. This is not a supply chain hiccup. This is a structural shift. And it is happening across every industry that depends on silver. Let me walk you through why this decision was made. Because it was not random. China is the largest consumer of silver for industrial purposes. Solar panels. China produces more solar capacity than the rest of the world combined. Every panel requires silver. No substitute exists that matches its conductivity. Electric vehicles. China is the dominant EV manufacturer globally. Every EV uses more silver than a traditional car. Batteries, wiring, electronics. All of it needs silver. Semiconductors, 5G infrastructure, data centers, AI chip production. Every single one of these industries is expanding in China at a rate that the rest of the world is struggling to match. So here's the calculation China made. We refine 70% of the world's silver. We consume massive amounts of it domestically. Our industrial growth is accelerating. Why would we keep exporting a material we need ourselves? The answer is simple. They would not. And they stopped. This is not temporary policy. This is strategic resource security. This is China looking at the next decade and deciding that silver is too critical to let leave the country. And for the rest of the world, that creates a problem. A big one. Let me show you the math. Global silver production is roughly 830 million ounces per year. China refines somewhere between 540 and 580 million of those ounces. Before this policy change, a significant portion of that refined silver was exported. Estimates vary, but somewhere between 150 and 200 million ounces per year left China and entered global supply chains. Now that flow is being choked. Even if half of those exports continue, that is 75 to 100 million ounces per year removed from the global market. Where does that shortfall get filled? Mexico is the largest primary silver producer. They mine around 200 million ounces per year. But Mexico has its own industrial demand, its own manufacturers, its own priorities. Peru produces roughly 120 million ounces. Same situation, domestic consumption, export agreements, political considerations. You cannot just redirect global refining capacity overnight. It takes years to build new facilities. It takes infrastructure. It takes regulatory approval. It takes investment that no one was planning to make because China was handling it. And now China is not. This is where the pressure starts building. Because the supply that just got restricted was not sitting in warehouses. It was already spoken for, already contracted, already built into production schedules. Solar companies have orders to fill. EV manufacturers have delivery timelines. Semiconductor fabs have production quotas. And the material they were counting on just became uncertain. What happens when supply becomes uncertain? Buyers start securing alternatives. They start paying premiums. They start stockpiling. And that creates a feedback loop. Reduced exports drive up prices. Higher prices make hoarding rational. Hoarding tightens supply further, prices rise again, and the cycle accelerates. We are watching the early stages of this cycle right now. Physical silver premiums in Asia have been rising. Not speculation, not futures contracts. Physical metal that companies need to keep factories running. In Japan, physical silver is trading at premiums that did not exist 6 months ago. In South Korea, same pattern. In India, buyers are paying above global spot prices just to secure delivery. This is not normal market behavior. This is what happens when the assumption of available supply starts breaking down. Now let me show you the part that most people are missing. Because the China export restriction is not happening in isolation. It is layered on top of other structural problems that we're already building. Silver has been in supply deficit for 5 consecutive years, meaning the world consumes more silver than it mines, every single year. The gap gets filled by drawing down existing stockpiles. But stockpiles are not infinite, and they have been draining. COMEX registered inventory has dropped 70% since 2020, from 346 million ounces to under 100 million. The London market is showing similar stress. Vault inventories are declining, lease rates are spiking, signs of physical tightness. And now on top of all of that, China just restricted the largest source of refined supply. This is not one problem, this is 3 problems compounding at the same time. Structural deficit, inventory depletion, export restriction, each one alone would be significant. Together, they create the conditions for a supply crisis. Let me give you a timeline, because this does not play out overnight. It unfolds in stages. Stage 1. Manufacturers start noticing delays, orders take longer to fill, prices creep higher. This is happening now. Stage 2. Spot shortages appear in specific regions. Certain grades of silver become hard to source. Premiums widen. This could happen within months. Stage 3. Major buyers start securing long-term contracts at elevated prices. They lock in supply because they cannot risk production shutdowns. This accelerates price increases. Stage 4. Smaller manufacturers who cannot afford higher prices start cutting production. Supply chains break at the weakest links. Industries that depend on just-in-time delivery face disruptions. Stage 5. Governments start paying attention. Strategic stockpile discussions begin. Export restrictions spread to other producing countries. The market fragments. We are somewhere between stage 1 and stage 2 right now, and the clock is ticking. Here is what makes this situation different from past supply squeezes. In previous tightness, the problem was temporary. A mine shutdown, a labor strike, a refinery fire. The market could wait it out. This time, the restriction is policy-based. It is intentional. It is not getting reversed because China wakes up one day and decides they do not need silver anymore. If anything, their domestic demand is growing, which means the rest of the world has to adjust to a new reality, a reality where the largest refining hub is no longer a reliable export source. And adjusting takes time. Time to build new refining capacity, time to develop alternative supply chains, time that industries running on tight margins do not have. The companies that move first, that secure supply now, that pay premiums today to avoid shortages tomorrow, those companies survive. The companies that wait, that assume the problem will resolve itself, that hesitate because prices seem high, those companies face production halts, contract penalties, lost market share. This is not speculation. This is how supply shocks work. And we are watching one unfold in real time. Now let me show you the parallel that almost no one is drawing, because this exact pattern has played out before. Not with silver, with rare earth elements, 2010. China controlled over 90% of global rare earth production. They were the refining hub, the price setter, the dominant supplier, and then they restricted exports. Suddenly, strategically, countries that depended on Chinese rare earths for military technology, for electronics, for green energy, they panicked. Prices spiked. Supply chains scrambled. Governments launched emergency programs to develop domestic sources. It took years, and in the meantime, China leveraged their control. Silver is following the same trajectory. China controls refining. China is restricting exports, and the rest of the world is unprepared. The difference is that rare earths had alternatives, expensive alternatives, slower alternatives, but alternatives. Silver in certain applications has no substitute. You cannot make a solar panel without it. You cannot make certain semiconductors without it. You cannot replace its conductivity with something cheaper, which means the leverage China just gained is deeper than the rare earth playbook, and the response time is shorter. So what happens next? Let me walk through the scenarios, because there are 3 paths this can take, and each one leads to a different outcome. Scenario 1, other producing countries ramp up refining capacity. Mexico, Peru, Australia, they see the opportunity. They invest in facilities. They start processing more silver domestically and exporting refined product. This takes 3 to 5 years minimum. In the meantime, supply stays tight, prices stay elevated, industries adjust. Some consolidate, some relocate, But eventually, the market rebalances. Scenario 2, China's restriction proves temporary. Political winds shift. Trade negotiations ease the controls. Exports resume at closer to previous levels. Possible, but unlikely. Because this policy aligns with China's long-term industrial strategy. And reversing it would signal weakness, something they avoid. Scenario 3, the restriction holds. Other countries cannot scale refining fast enough. Supply stays constrained. Prices rise to levels that force demand destruction. Industries that depend on silver either find substitutes, which do not exist, or scale back production. This is the scenario that creates systemic stress, because you cannot just shut down solar panel production. You cannot halt EV manufacturing. These are industries with momentum, with government mandates, with investment commitments. And if the material they need is not available, the entire policy framework around green energy, around electrification, around decarbonization, that framework starts cracking. Here is what the data is showing right now. Chinese silver exports dropped sharply in the first weeks after the policy took effect. Not zero, but significantly lower than historical averages. Buyers in Japan and South Korea reported longer lead times and higher costs almost immediately. European manufacturers flagged concerns in industry reports. The London Metal Exchange saw silver lease rates jump, a sign that borrowing physical metal is getting more expensive, which only happens when supply is tight, and COMEX registered inventory continues to drain, meaning the stockpile that is supposed to act as a buffer is shrinking at the exact moment it is needed most. These are not predictions, these are observations, and they all point in the same direction. Tightening supply, rising stress, approaching limits. Let me tell you what this means for the price, because that is what most people want to know, and the answer is not simple. In a purely supply-driven market, restricted exports plus rising demand equals higher prices, basic economics. But silver does not trade in a purely supply-driven market. It trades in a paper market where contracts outnumber physical metal by ratios that should not exist. So the question is not what happens to supply. The question is what happens when the paper market and the physical market start showing different prices, which is already happening. Physical silver in Tokyo is trading above the COMEX price. Physical silver in Dubai is trading at premiums. Physical silver in Shanghai is not even accessible to Western buyers. This is the beginning of a two-tier market. Paper price on one side, physical price on the other, and the gap between them widening. At some point, that gap becomes undeniable. At some point, industrial buyers stop trusting the paper price and start paying the physical price. And when that happens, the entire pricing mechanism shifts. We are not there yet, but the pressure is building. And China's export restriction just accelerated the timeline. Now, let me address the question you're probably asking. What does this mean for someone holding silver? What does this mean for someone thinking about it? I'm not here to tell you what to do. I am here to show you what is happening. What is happening is that the largest refining source in the world just restricted supply. What is happening is that industrial demand is rising while stockpiles are falling. What is happening is that the gap between paper and physical is widening. These are structural shifts, not temporary volatility, not speculation, structural. And structural shifts create opportunities for those who see them early, and pain for those who do not. The companies that secure supply now are positioning themselves for the next 5 years. The investors who understand what restricted exports mean are positioning themselves for a market that looks very different in 12 months. And the people who ignore it, who assume someone else will solve the problem, who wait for certainty before acting, they are the ones who pay the highest price when the system adjusts. Here is the part that should keep you awake, because it is not just about silver, it is about what silver represents. Silver is a test case, a material that is industrially critical, globally traded, and concentrated in refining capacity. And we just watched that concentration get weaponized. If this works, if China successfully restricts exports without major pushback, what stops them from doing the same with other materials? Cobalt, lithium, graphite, rare earths they already control. What stops other countries from following the same playbook? If you produce something the world needs, why not restrict exports and prioritize domestic use? This is the fragmentation of global supply chains. This is the end of the assumption that materials will always be available at market prices. This is the return of resource nationalism, and silver is just the beginning. If this continues, the price will not be the real problem. The real problem will be availability. The real problem will be industries that cannot produce because they cannot source materials. The real problem will be supply chains that were built on assumptions that no longer hold. By the time the headlines admit it, by the time the financial networks start covering it, by the time governments convene emergency meetings, it will already be too late. The moves that matter happen now, in silence, in the weeks and months before the crisis becomes obvious. Someone is securing supply right now. Someone is paying premiums right now. Someone is positioning for a world where silver is not freely available. The question is whether you see it. or whether you wait until everyone else does.